Welcome back to Talk Tickers, where we do the heavy lifting and break down earnings calls so you don't have to.
That's right.
Today, we're diving into Amwell's Q4 2024 report.
Yeah,
And wow, they just wrapped up a year of major transformation.
absolutely. This was a pivotal year for Amwell. They really doubled down on their core strengths and made some strategic moves to set themselves up for some pretty ambitious goals in 2025. The biggest one, they're aiming to be cash flow positive.
Cash flow positive, that's the holy grail, right? So before we get into the weeds, what's the big picture here? Remind us what Amwell's all about.
Think of Amwell as the bridge between you and your doctor, but online, virtual appointments, mental health support, it's all about making healthcare accessible from anywhere.
Okay, so they're playing in the digital healthcare space.
Yeah.
Got it. Let's talk numbers. What did their Q4 revenue look like?
They brought in $71 million in revenue for Q4, which was flat compared to last year. But here's where it gets interesting. There's a lot happening beneath the surface.
Ooh, I love when there's more than meets the eye.
Yeah.
Give me the scoop.
Amwell is shifting its focus from one-off virtual visits to a subscription-based model. Think of it like Netflix for healthcare, a steady stream of recurring revenue. And it's working. Their subscription revenue jumped a whopping 36% year over year, reaching $37 million.
So they're not just providing virtual visits anymore. They're building a whole platform like an operating system for healthcare. That's a smart move.
Yeah.
Recurring revenue is much more predictable and stable, which is what investors love to see.
Exactly. And they're not just attracting individual users, they're landing some big fish. One of their biggest wins this past year was a massive contract with the military health system. We're talking about providing their platform to 9.6 million people.
Wow, 9.6 million. That's a huge vote of confidence. Talk about a game changer.
It's a huge deal, and it shows how Amwell is positioning themselves as the go-to platform for large institutions. This contract alone is expected to drive a big chunk of their revenue growth in the coming year.
That makes sense. And to your point about recurring revenue, it sounds like Amwell is really putting their money where their mouth is. They even made some tough choices this year, right?
Yes. They decided to sell off their psychiatric staffing business, Amwell Psychiatric Care. It was a bold move, considering it meant giving up potential revenue, but it shows their commitment to focus on their core strength, the platform.
So they're streamlining, getting laser focused on what they do best. That sends a strong signal to investors that they're serious about profitability.
Exactly. They're playing the long game here, and they're willing to make tough decisions to achieve their goals.
Okay, I'm definitely intrigued. They're making bold moves, landing huge contracts, and streamlining their business.
Yeah.
Where do they go from here? What's on their agenda for the coming year?
They've outlined three main priorities: growth, recurring revenue, and efficiency.
Sounds like a solid plan. Can you break those down for us?
For growth, they're going to leverage their existing partnerships, like that massive military health system deal, to really showcase what their platform can do. They're also actively pursuing new contracts with payers and health systems, recognizing the growing demand for digital healthcare solutions.
So they're striking while the iron is hot, using their success with the military health system to open doors.
Precisely. And when it comes to recurring revenue, their focus is on building lasting relationships with clients and making their software platform even stickier, so to speak. They want to become indispensable to their clients' operations.
And efficiency.
Efficiency is all about continuing to reduce costs and streamline their operations. Think of it like fine-tuning a machine to ensure every part is working at its best.
So they're trimming the fat, getting lean and mean to maximize profitability.
Makes sense. All right, so Amwell is in a very interesting position. They're riding the wave of digital healthcare. They've got momentum, and they're making some bold strategic moves. But can they actually pull it off? Can they deliver on these ambitious goals, especially when it comes to profitability?
That's the million-dollar question, isn't it? And it's something investors will be watching very closely.
Well, on that note, let's dive into their guidance for the year ahead. What are they projecting? They're predicting revenue between $250 million and $260 million for 2025. But remember, that's excluding the revenue they would have had from the psychiatric staffing business they sold off.
Right, so they're essentially starting with a clean slate, focusing on their core platform. And what about that recurring revenue they're so focused on?
They're expecting their subscription software revenue to make up almost 60% of their total revenue this year. That's a huge jump, and it shows just how committed they are to this model.
It's a clear sign that they see the future of their business in providing a comprehensive platform, not just one-off visits. They're thinking long-term, building an ecosystem. That's really interesting.
They're also anticipating some interesting quarterly dynamics, particularly with the ongoing rollout of their platform to the military health system.
Okay, what do you mean by interesting dynamics?
They're projecting a one-time jump in software revenue in Q2 as they complete a major phase of the deployment. After that, it'll normalize a bit, but still contribute significantly to their overall software revenue for the year.
So a bit of a spike in Q2, but overall, a steady stream of recurring revenue from that massive contract. Got it.
And perhaps most importantly, they're projecting a significant improvement in adjusted EBITDA, aiming for a range of negative $55 million to negative $45 million for 2025.
Whoa, hold on. For those of us who aren't financial wizards, break down what that means. Why should we care about adjusted EBITDA?
Think of adjusted EBITDA as a way to measure a company's core profitability. It strips away things like one-time expenses or accounting quirks, giving you a clearer picture of how the business is performing at its core.
Okay, that makes sense. So they're projecting a smaller loss, which means they're moving closer to profitability.
Exactly. It demonstrates their dedication to reaching that cash flow positive goal by next year.
So things are looking up, but are there any potential red flags investors should be aware of? What are the risks here?
Well, one thing to consider is the inherent uncertainty around the timing of government contracts. These deals can be complex and lengthy, so there's always a risk of delays or unexpected changes that could impact their revenue projections.
That's a good point. Government bureaucracy can be a fickle beast.
What else? Another factor is competition. The digital healthcare market is a hot space right now, with new players popping up all the time. Amwell needs to continue innovating and differentiating themselves to stay ahead of the curve.
It's not enough to just have a good platform. They need to keep pushing the boundaries.
Yeah.
What else should investors be thinking about?
Well, they need to prove that their platform is more than just a virtual visit facilitator. They need to show how their technology can truly transform healthcare delivery, improve patient outcomes, and save money for their clients.
So it's not just about connecting doctors and patients online. It's about building a truly integrated ecosystem that streamlines the entire healthcare experience.
Absolutely.
Mhm.
And if they can successfully achieve that, they have the potential to become a real powerhouse in the digital healthcare space.
All right, let's shift gears a bit and take a closer look at their financial performance.
In Q4, Amwell reported an adjusted EBITDA of negative $22.8 million. Now, that might sound like a lot, but it's actually a considerable improvement compared to negative $36.9 million in the same period last year.
So they're moving in the right direction. What's driving this improvement?
Their strategic focus on growing that subscription software revenue while simultaneously reducing costs is paying off. They're becoming more efficient, and it's showing in their financials.
And that's what investors like to see. Efficiency and profitability go hand in hand. What about their cash situation? How are they doing on that front?
They ended the year with a healthy cash position of $228 million and no debt. That gives them a solid financial foundation to pursue their growth strategy.
So they've got money in the bank and no debt hanging over their heads. It's a good sign. It means they have the resources to invest in innovation and weather any storms that might come their way. Speaking of resources, let's dig a bit deeper into their cost reduction efforts. What have they been doing to streamline their expenses?
They've implemented several key initiatives to control their spending. For instance, they've significantly reduced their R&D spending, which is a positive sign that they're becoming more efficient in developing and deploying their platform.
So they're getting more bang for their buck when it comes to R&D. That makes sense, especially since they've already built a solid platform. What else are they doing?
They've also made significant cuts to their sales and marketing expenses, demonstrating their commitment to optimizing their spending and focusing on high-impact initiatives.
Smart move. No need to spend money on marketing if you've got a killer product and a solid reputation. Any other areas where they're cutting costs?
One area they're still working on is reducing their general and administrative expenses, but they're targeting a significant decrease in this area in 2025.
So they're making progress on multiple fronts to control costs and position themselves for profitability. It sounds like they're really tightening the belt. Okay, now let's talk about their visit metrics. I know this has been a bit of a mixed bag for them lately. What's the latest?
In Q4, they completed approximately 1.4 million visits, which was down about 18% compared to last year. This was largely in line with their adjusted expectations and reflects some market-wide softness in demand for virtual visits.
So fewer people are using their platform for virtual visits.
Yeah.
That sounds a bit concerning.
It might seem that way at first glance, but it's important to remember that Amwell is strategically shifting away from relying solely on visit revenue. Their focus is on that recurring revenue from subscriptions, which offers more stability and higher margins in the long run.
So the decline in visits isn't necessarily a bad thing as long as their subscription numbers are strong.
Exactly. And while the total visit volume was down, it's worth noting that the proportion of visits conducted on their newer Converge platform remains steady at around 70%.
Hold on, back up a sec. What's the Converge platform?
Think of Converge as their next generation platform. It's more advanced, more integrated, and offers a wider range of features and services.
Okay, so the fact that 70% of visits are happening on Converge is a good thing, right?
Absolutely. It's a positive sign that their clients are adopting and utilizing their more advanced platform, which is key for their long-term growth strategy.
Makes sense. So even though overall visit numbers are down, the fact that they're happening on their more advanced platforms suggests that their clients are happy and engaged. What other positive indicators are there?
Another encouraging metric is their average annual contract value, or ACV, which increased for both health plans and health systems in 2024.
Okay, break that down for me. What does that mean and why is it important?
ACV basically tells you the average amount of money they're making from each client annually. The fact that it's increasing means they're successfully expanding their relationships with existing clients and securing larger contracts.
So they're not just holding on to clients, they're deepening those relationships and getting more value out of them. That's a great sign for future revenue growth.
Exactly. So while the visit numbers might not be exploding, there are other positive indicators suggesting that Amwell is gaining traction in the market and building a solid foundation for sustainable growth.
They're playing the long game, building a solid foundation for the future.
Got it. What else is going on that we should know about?
Well, let's not forget about their partnership with Vita Health, which they added to their platform in Q4. This partnership expands their offerings to include obesity and diabetes care, including access to GLP-1 medications.
Okay, I've been hearing a lot about GLP-1 medications lately. They're all the rage.
They are, and this partnership is a strategic move by Amwell to capitalize on that growing demand. It allows them to further diversify their offerings and attract a wider range of clients.
So they're not just focused on virtual visits anymore. They're branching out into specialized care areas. That makes them a more attractive partner for payers and health systems looking for comprehensive digital healthcare solutions.
Exactly, and it shows that they're not afraid to adapt and evolve to meet the changing needs of the market.
It's all about staying ahead of the curve. So they've got the technology, they've got the experience, and they've got the financial resources to compete. Now it's all about execution and demonstrating the value of their platform to potential clients. Absolutely. And that brings us to their growing pipeline of potential deals. They're seeing increased interest from both commercial and government clients, suggesting that their platform is resonating with a wider audience.
Their success with the military health system is a testament to their ability to handle large-scale, complex deployments. That's giving them a real edge in competitive bids.
It's definitely working in their favor. They're showing potential clients that they can deliver, and that's building trust and confidence.
Okay, we've covered a lot of ground here. Before we move on, let's take a moment to recap what we've learned from Amwell's Q4 2024 earnings call.
They're focusing on three key priorities: growth, recurring revenue, and efficiency. They're making significant progress towards profitability, but it's still a work in progress. And they're facing some challenges like government contract uncertainty and a competitive market.
But despite those challenges, they have several things going for them. A massive contract with the military health system, a growing pipeline of potential deals, a healthy cash position, and a dedicated focus on achieving their goals.
They're playing the long game, and they're making the right moves to position themselves for success.
All right, stay tuned for part 2 of our deep dive into Amwell, where we'll be taking an even closer look at their financials and analyzing their growth potential.
Welcome back to Talk Tickers. Before we jump into Amwell's performance and their potential for growth, let's take a step back and break down their financials from Q4.
Sounds good to me. Their strategic shift to focus on recurring revenue and streamline operations seems to be paying off. Let's see if the numbers back that up. Where should we start?
A good place to start is their gross profit margin, which hit a healthy 48% in Q4. That's an impressive 11-point jump from the previous quarter.
Okay, for those of us who don't spend all day crunching numbers, what does that tell us? Why is gross profit margin so important?
Imagine you're running a lemonade stand. Your revenue is the money you make selling lemonade. Your gross profit is what's left after you pay for the lemons, sugar, and cups. The gross profit margin is that profit expressed as a percentage of your revenue. So a higher gross profit margin means you're keeping a larger portion of your revenue after covering those direct costs.
Okay, I get it. So in Amwell's case, their higher gross profit margin means they're becoming more efficient at delivering their services and managing their costs. They're making more lemonade with each lemon, so to speak.
Exactly. It's an important indicator of their operational efficiency and their ability to scale their business profitably. Now let's zoom in on their operating expenses, where Amwell has been diligently working to normalize their R&D spending.
What does normalizing R&D spending even mean? Are they cutting back on innovation?
Not necessarily. Normalizing R&D means finding a sustainable level of investment that aligns with their long-term goals. In Q4, their R&D expenses were $18.8 million, a substantial decrease of almost 29% compared to the same period last year. This reduction is partly because they've completed a large chunk of the software configuration work for their existing commitments, like the massive deployment for the military health system.
So they're not just slashing R&D, they're being more strategic and focusing on areas that will drive future growth, like maximizing the value of that big military contract.
That's a great way to put it. They're also exercising greater control over their sales and marketing expenses, which decreased by approximately 8% compared to the previous quarter and a whopping 29% compared to the same period last year.
Wow, those are some serious cuts.
Yeah.
That shows real commitment to efficiency. What's driving these cost savings?
It's a combination of things. They've implemented cost-cutting initiatives, shifted toward more efficient marketing strategies, and they're really focusing on leveraging those existing client relationships for growth rather than always chasing new ones. And they're also working on streamlining those general and administrative expenses, though there's still room for improvement there.
Sounds like they're turning over every stone to find efficiencies. It's like they're Marie Kondoing their entire business.
That's a perfect analogy. They're definitely striving to create a leaner, more agile organization that can compete effectively in this fast-paced digital healthcare market.
Okay, so they're keeping costs down. But what about their cash flow and overall financial health? Are they in a good position to weather any storms and continue investing in growth?
Absolutely. They wrapped up 2024 with a robust $228 million in cash and marketable securities, and they have no debt. That's a fantastic position to be in.
It's like they've got a healthy emergency fund and no credit card debt. That gives
Yeah.
them a lot of flexibility and peace of mind.
Exactly. And based on their projections, they anticipate ending 2025 with around $190 million in cash and maintaining over $150 million in cash by the end of 2026. This shows they're confident about reaching positive cash flow in the near future.
So they're projecting a strong cash position even as they invest in growth and continue their march toward profitability. That's reassuring for investors. Now let's dig a bit deeper into how they're making money. We know they're shifting towards subscription revenue, but what about those other revenue streams? Are they just phasing those out entirely?
Not quite. Their AMG or Amwell Medical Group visit revenue showed a 9% decline year over year, landing at $29.2 million in Q4. However, their average revenue per visit actually increased by 7% compared to last year. This shift is driven by their focus on higher value services like virtual primary care and specialty programs.
So even though they're doing fewer virtual visits through their Amwell Medical Group, they're making more money from each visit. It's like trading quantity for quality.
Exactly. They're moving away from basic virtual checkups and positioning themselves as a provider of more complex and specialized digital healthcare solutions. It's a smart move to differentiate themselves and command higher prices.
Now, what about that service and care points revenue category we saw earlier? What's that all about?
Their service and care points revenue decreased to $4.9 million in Q4 compared to $7.3 million in the previous quarter. This dip is mainly due to the timing of marketing revenue, which can fluctuate depending on customer buying patterns.
So it's not necessarily a cause for concern, more of a timing quirk.
That's right. It's important to remember that their business model, which includes professional service milestones and marketing programs, can create some variability in how and when revenue is recognized. But the big picture is that their revenue mix is increasingly leaning towards a larger proportion of that stable, high-margin subscription revenue. That's a good sign for their long-term financial health.
It's like building a solid foundation for a house. You need that strong base to support everything else.
Perfect analogy. Now let's circle back to their guidance for 2025. Remember, they're projecting revenue between $250 million and $260 million, with almost 60% coming from subscription revenue. They're also aiming for a significant improvement in adjusted EBITDA, targeting a range of negative $55 million to negative $45 million.
Those are some ambitious goals. But based on their Q4 performance and their laser focus on efficiency, it seems like they might just pull it off.
I agree. They're demonstrating a strong understanding of the market dynamics and are adapting their strategy accordingly. This focus on efficiency, coupled with their expanding pipeline of deals, puts them in a great position for sustainable growth in the coming years.
Speaking of transparency, it's great that they're providing quarterly guidance going forward. It's like giving investors a roadmap to track their progress.
Transparency is key. It allows investors to see how the company is executing its plan and make more informed decisions. Now let's dive into the strategic initiatives they're banking on to achieve this growth in 2025.
They mentioned three main areas: growth, recurring, revenue, and efficiency. What specific actions are they taking in each of those areas?
First up, they're laser focused on executing those deliverables for the military health system. This massive contract is a cornerstone of their growth strategy, and they're committed to ensuring its successful implementation.
It's like landing a huge client. You need to make sure you deliver on your promises and keep them happy.
Exactly. And beyond the military health system, they're actively pursuing new government channels, recognizing the vast potential of this market segment. They're leveraging the experience and expertise they gain from that big deployment to target other government healthcare providers.
It makes sense to capitalize on that success. They've proven they can handle large-scale, complex projects, so why not go after more government contracts? They're in a great position to do so.
Absolutely. And while they're busy winning over the government, they're not neglecting the private sector. They're also actively pursuing new contracts with payers and health systems, recognizing the growing demand for digital healthcare solutions in these segments.
So they're playing a two-pronged approach, tackling both government and private sectors. It's like diversifying your investments. You don't want to put all your eggs in one basket.
That's a great way to think about it. And it's not just about their core platform either. They're expanding their portfolio of clinical programs by partnering with third-party providers like their recent collaboration with Vita Health to offer obesity and diabetes care.
That partnership with Vita Health is a smart move. It allows them to tap into the growing demand for specialized care areas like obesity and diabetes management, and it broadens their appeal to a wider client base.
It's all about offering a comprehensive suite of services catering to a diverse range of healthcare needs. This strategy opens up additional revenue streams through partnerships and integrations, making them a more attractive partner for everyone involved.
So they're firing on all cylinders. Organic growth through their platform strategic partnerships to expand their offerings, and a dual focus on government and private sector clients. That's a well-rounded approach.
They're covering all their bases. This diversified approach, combined with their commitment to efficiency and recurring revenue, puts them in a fantastic position to capitalize on the evolving digital healthcare landscape.
Okay, we've covered a ton of information. Let's take a quick breather and recap the key points before we dive into the final part of our deep dive.
Sounds good. We've looked at Amwell's impressive Q4 performance, highlighting their healthy gross profit margin, their significant cost reductions, and their strong cash position. We've also explored how their revenue breakdown is evolving with a clear shift towards subscription-based income.
And we've analyzed their projections for 2025, which paint a picture of solid revenue growth and continued progress towards profitability. Plus, we've examined their multifaceted growth strategy, which involves going after government contracts, partnering with payers and health systems, and expanding their service offerings through collaborations like the one with Vita Health.
In the final part of our analysis, we'll tackle some of the risks and challenges Amwell faces and explore the potential opportunities that lie ahead. Stay tuned.
Welcome back to Talk Tickers. We've spent the last two segments breaking down Amwell's Q4 2024 performance and their plans for the future. They've made some big moves, but the question is Amwell a good investment? What are the key takeaways for investors?
Well, I think the main takeaway is that Amwell is at a crossroads. They've made really impressive progress in transforming their business, shifting their focus toward that higher margin recurring revenue and streamlining their operations.
They're putting their money where their mouth is when it comes to profitability. Their cost-cutting measures are significant, and their guidance for 2025 suggests they're on the right track. But as with any investment, there are always risks. What should investors be watching out for?
One thing to keep in mind is their reliance on government contracts. While that military health system deal is a huge win, government budgets and priorities can change quickly. Delays or cancellations could impact their revenue projections.
That's a valid point. Government contracts can be a bit of a wild card. And let's not forget about competition. The digital healthcare market is getting crowded. How can Amwell stand out from the crowd and attract new clients?
They need to keep innovating and proving that their platform is more than just a virtual visit tool. It's not enough to simply connect patients and doctors online. They need to offer a comprehensive suite of services that really address the evolving needs of healthcare providers and payers.
So it's about creating a true digital healthcare ecosystem, not just a one-trick pony. Their partnership with Vita Health is a good example of how they're expanding their offerings and addressing specific healthcare needs. But they can't rest on their laurels. They need to keep pushing the boundaries and developing solutions that set them apart from the competition.
Absolutely. And they can't forget about building strong relationships with key players in the healthcare industry like health systems, payers, and government agencies. Navigating those relationships and securing favorable contracts will be crucial for their long-term success.
It's a delicate dance, and they need to be strategic in how they approach each of these segments. What about the regulatory landscape? Digital health is still a relatively new field. Are there any potential roadblocks there?
Well, the regulatory landscape for digital health is constantly evolving, and increased scrutiny from regulators is inevitable. Amwell needs to be agile and adaptable to stay ahead of the curve and ensure they're compliant with all the rules and regulations.
It's a bit of a moving target, but they can't afford to fall behind. They need to be proactive and anticipate potential changes in the regulatory environment.
Okay, so we've talked about the risks. What about the potential upside? What are the biggest opportunities for Amwell going forward?
One of the biggest opportunities is the continued growth of telehealth and virtual care. The pandemic accelerated this trend, and it's likely to continue even as things return to normal. Consumers are becoming more comfortable with accessing healthcare remotely, and providers are increasingly embracing telehealth as a way to expand access to care, improve efficiency, and reduce costs. Amwell is in a prime position to capitalize on this trend. They have a proven platform, a growing network of providers, and a deep understanding of the digital healthcare space. And their focus on building a comprehensive platform that goes beyond simple virtual visits could give them a significant edge.
Exactly. Another opportunity lies in harnessing the power of data and analytics. Amwell has access to a vast amount of data through their platform, which they can analyze to identify trends, predict risks, and personalize care.
It's like having a treasure trove of information just waiting to be unlocked. They can use this data to improve healthcare outcomes, make providers more efficient, and help patients take a more proactive role in managing their health.
With the rise of artificial intelligence and machine learning, the possibilities for data-driven healthcare innovation are endless. Amwell has the potential to be at the forefront of this revolution.
It's an exciting time to be in the digital healthcare space, that's for sure.
Okay, before we wrap up, it's time for our favorite segment. This is not financial advice.
Oh boy, here we go. Always a good time. Remember, this is purely hypothetical, just for fun. Okay, here's a wild trade idea. Amwell is already making waves in government healthcare with the Military Health System contract. What if they become the dominant platform for telehealth in the entire Veterans Affairs system?
That's a bold prediction. The VA is a massive healthcare provider serving millions of veterans across the country. Landing a contract of that scale would be a game changer for Amwell.
Imagine the potential growth. Their stock could go through the roof. But again, this is just a wild idea, not financial advice.
It's a long shot, and there would be plenty of hurdles to overcome. But it's definitely fun to think about the possibilities.
It speaks to the massive potential that Amwell has if they play their cards right. They're in the right place at the right time with the right technology and the right team.
So to sum it all up, Amwell is facing both challenges and opportunities as they navigate the ever-evolving digital healthcare landscape. Their success will depend on their ability to execute their strategy, innovate, and prove the value of their platform.
It's a company worth watching, and we'll be keeping a close eye on their progress in the coming quarters. Thanks for joining us on Talk Tickers. We'll be back next week with another deep dive into the world of earnings calls.